Welcome back. In the last step, we talked about the first two ways you can make money investing in stocks: value increases and dividend payments, or coupon payments when we're talking about bonds. Compound interest is so important, and you'll see it pop up a lot throughout Finasana. It can make you rich, or it can make you poor, so we hit on it a lot. Albert Einstein famously called compounding the most powerful force in the universe. So what is it exactly? Compound interest is interest on interest. Or said differently, when your money makes you more money, and then that money makes you even more money, like a snowball effect. If you think of a snowball starting off at the top of a mountain, the first time it rolls, it will coat its entire surface area with a fresh layer of snow. It repeats this again and again until it gets to the bottom of a hill. The bigger the hill, the bigger and faster the snowball will get. To compare this to money, the initial snowball at the top of the hill is the money that you start with. The fresh snow that piles up is your increase in value or return. And the size of the hill is time. The opposite of compound interest is simple interest. If you start with $100 and you know you're going to get 10% simple interest every year, that means you'll make $10 every year because 100 times 10% is 10. After 3 years, you'll have $30. Simple, right? That's simple interest. But with compound interest, that $10 every year doesn't stay the same. It gets bigger and bigger as your account balance gets bigger. How does that actually work? Basically, as you make money every year, instead of cashing out those $10 and buying a couple Starbucks lattes, you don't touch it. And instead, let your balance grow. As your account balance gets bigger, compound interest means you'll earn a percentage of that new balance instead of the flat $10 from simple interest. You earn interest, or new money, on money that you previously earned and wasn't actually yours to begin with. If interest compounds annually, or gets added to your principal balance every year, in the first year, you'll still make the same thing between both compound and simple interest. That's because your starting balance is the same. The second year, however, things start to diverge. Simple interest will give you $10, and it makes no difference to next year's interest if you use that money to buy yourself something. But with compound interest, as long as you don't spend the money and leave it invested, you'll actually earn 10% on the new, higher balance of 110, which means you'll get paid 11 instead of 10. All because your snowball, or account balance, is getting bigger. And that keeps going. If we follow this pattern, by the third year, you'll be making about $12 a year. After 3 years of annual compounding, the total difference between simple and compound interest will be about $3, which isn't very much. But if you keep letting the snowball roll down the hill, after 20 years, compound interest means your balance will be more than double what it would have been with simple interest. After 30 years, the difference is even more pronounced. We're talking about more than 4 times as much money. And this difference only gets larger and more pronounced with time. This also assumes annual compounding. But compounding can occur quarterly, monthly, or even daily, meaning your money would grow even faster. So why is this relevant to you? When you invest in the stock market, the longer you leave your money in, the more you'll benefit from compounding. The results are even more dramatic if you get paid dividends, which we covered earlier as the thank you payments companies pay. If instead of using the dividends to buy yourself something nice, you reinvest them, compound interest is at work. This is called dividend reinvestment, and we'll go into more detail later. The key takeaway from this step is that compound interest works as a snowball effect for your money. It makes it way bigger. But that applies to your investments or your credit card bill equally. But we're not done with compound interest just yet. In the next step, we'll put the math away and talk about why you should care about it so much.